I'm so glad to have Tom Bowley, my friend and fellow technician. Tom's been doing this a lot longer, at least on the advisory side, as far as analyzing the markets. And he's just got a great story. He'll give you some of his background, but I just want to cover a little bit of this now. He's the chief market strategist at Earnings Beats. He provides stock market education, guidance, trading strategies, and I put this in yellow. Using a unique combination of technical, fundamental, and historical analysis. I'm a technician, so when I met Tom, discovered his analysis that included fundamental and historical, mainly because he's got a CPA that he did for 20 years. I really became interested in it. He's got four portfolios that he tracks. He benchmarks those to the S&P, just as we do for you guys. Writes frequently for trading places and live on stock charts. Tom actually introduced me to being a guest presenter on stock charts. You guys know, but I announced that 3 weeks ago on this program. So Tom comes to us tonight from his office in South Carolina. Please welcome with me, Tom Bowley.
Hey, Charlie, how you doing?
I'm doing great, buddy. It's great to see you. I feel like that maybe I'm keeping you from the first NFL game here. I got to look at the schedule very carefully, did I?
Well, I didn't look at it very carefully when I said I would be on tonight.
Well,
that was on me.
Well, it'll be short, and with any luck, you won't miss too much. Maybe there'll be some opening drama, with the. All right. So, first question: just tell us a little bit about your accounting and trading background and what prepared you for. You really have a dual career. You're a stock charts presenter, commentator. You do live presentations, and of course, you have this earnings beats business, which is how I met. And I'm full disclosure, I'm one of Tom's customers.
Yeah, I actually started out on the fundamental side. So I graduated school with an accounting degree and passed the CPA exam back, I guess, I don't want to date myself, but 1984. And I was in public accounting for 20 years. I was in one of the largest CPA firms in the Washington, D.C. metropolitan area. And I was the chair of the accounting and auditing committee, was a partner there for probably the last 5-6 years that I was with the firm. So I've got, maybe a little bit more of a fundamental background than a lot of technical analysts. So I think it served me well because I like to really combine both fundamentals and technicals. And of course, that analytical background, being a CPA, really, I think, set a fire under me to analyze the market from a historical perspective. And there's a lot of facts from a historical perspective that I think a lot of folks would find very interesting. And I'll just give you one of those just to give you an example. And many of your listeners may not realize this, but since 1950 on the S&P 500, the entire S&P 500 gain has been made between the 26th of one calendar month to the 6th of the other calendar month, of the next calendar month. So that's every calendar month. So I'm talking about going from January 26th to February 6th, February 26th to March 6th, and so forth. This accounts for about 1/3 of the trading days since 1950, and yet it accounts for 100% of the gains. So that's the time of the calendar month, if you're a trader, that you really want to concentrate on from the long side.
Tom, how much of that do you think is because of what we call the 401k influence? I've talked to my clients about this, that so much new money, I mean, my actual clients will put money in their paychecks or whatever sometimes, and it's inflows that happen, and of course at a mass level, at the institutional level.
Yeah, I first noticed this when I was in public accounting, and I would go out and, of course, audit companies, and part of the audit included payroll. And one of the things I noticed, I've always been very passionate about the stock market, but I just noticed, hey, a lot of my clients here have payrolls that end on the 1st or the 15th of the month, and those monies are collected and then sent off to, I don't know, Vanguards of the world. And Vanguard takes that money, and Vanguard doesn't say, well, now's not a good time for us to invest this money for you. They don't have the right to make that decision. They take your money and they invest it, whatever, directives you've given. So a lot of this money, and we're talking, billions of dollars that come into the market all the time, this new money, it goes right into the market at the beginning of the month and a lot of times the middle of the month. And if you do the analysis that I've done and you look at the performance of the S&P 500 by each day of the calendar month, it's amazing how the performance, as you get closer and closer to the first of the month, things start picking up. And I call it legalized front running. I think you got a lot of folks that know this money's coming in, so they start buying. And then the money comes in, drives prices higher, and then you get a period of profit taking, and then it's rinse and repeat as you get close to the 15th of the month.
Yeah, it's pretty amazing. I want to talk about a quote of yours from earlier in the week that I really liked. These last few days, I don't believe we're seeing mass distribution of growth stocks, and this, guys, is talking about this correction we've had since last Thursday. What I believe is we're seeing mass manipulation. Just like in March, all of the day's selling comes at the opening bell. Longer term, however, leaders lead, and that's why buying leaders during periods of selling makes great sense for those willing to accept higher levels of short-term risk. There's a lot in that statement. I'd love you to unpack that for our listeners.
Well, one thing that I noticed, when I looked back at what happened in March and late February, I realized that a lot of the selling that was taking place at the opening bell. So we would wake up to futures, Dow Jones down 1,200 points, 1,400. You get closer and closer to the open. Then it was 1,500. And it literally was becoming almost a mass hysteria as we went through that period. And the problem is the market discounts everything that it can possibly think of when we start to panic and we go into panic mode.
Sure.
But the difference between March of 2020 versus, say, October of 2008, when we had the financial crisis, we had similar drops over similar periods of time. But what I can tell you is that the S&P 500 back in October during the financial crisis, we only gapped down the net amount it was like a 3 or 4 week drop. The net amount of gap downs represented about 16% of the move to the downside. 84% was selling during the trading day. So that's where I start thinking distribution. That's where a lot of your big funds were selling during the day.
And that's 2008 and 9, but it's very different now.
It was completely different in March. In March, we saw almost the exact same percentage drop over a very similar number of days, maybe an extra week in there in 2020. But only 7% of that drop occurred during the trading day. 93% of the drop occurred at the opening bell. So when I talk about distribution, portfolio managers, pension funds, they can't put in market orders at the opening bell. That's not how they get out. They have to sell during the day. And so I was not seeing distribution back in March. And I actually wrote an article over at Stock Charts on March 13th. And I said, I believe we're still in a secular bull market. And I know probably a lot of people looked at that and said, well, that's a lot of bull. But they probably weren't thinking market after it. But as it turned out, I think I was right. I think that this market, we had a great economy in February before we had this panic-induced sell-off in March. And I think now we're recovering very quickly, and I see a strong economy ahead.
Tom, let's segue on what you just said to this chart. I call it, this is Tom's famous 100-year chart. I really, really like this. So I've got you on camera, Tom, and I'm just backing off here, and we're showing this 100-year chart. And it's basically your belief that we are in a long-term secular bull market. Listeners of my program know that I've showed you this chart. This is the guy who, designed the chart. So from the horse's mouth, so to speak, tell us why this chart is so important, I think, for the long-term investor to picture, especially on these days when the market's selling off hard.
Yeah, it's really hard when you're caught up in the market on a day-to-day basis to step back and look at a long-term chart. And I'm a short-term trader, so I understand that that's a difficult thing to do sometimes. But in the overall context, it's important for me to think or to realize, that we are in either a secular bull market or a secular bear market. And secular meaning long-term. You can have a cyclical bear market like we had back in March, cyclical meaning short-term. You can have a short-term bear market within a long-term bull market. And in fact, if you go back and you look at that chart that you have on the screen, I didn't circle it on this particular chart, but throughout the 1950s and 1960s, there were multiple recessions, but we remained in a 20-year uptrend. And then you go into a secular bear market. Look at the three red shaded areas. They all look very, very similar, where you go through a period of about a dozen years and you go nowhere. It's simply sideways. That is a secular bear market. It was painful from 2000 to 2013 until we broke out. But once you break out of these sideways periods, these long-term secular bear markets, we have a history of moving up roughly another 2 decades after that. So this would take us potentially into maybe the early 2030s. Now, it doesn't mean we're not going to have scary moments in the market. If you go back and you look, 1987, there was a big market crash in 1987. That was within the confines of a 20-year secular bull market. 10, 12 years after that, you wouldn't have cared whether you bought the day before the crash or 3 weeks later at the bottom of the crash. You still would have done really well. And I think when we look back in our history books 10, 12 years down the road, I think we're going to look back at 2020 and think the same thing.
Yeah, I hear that. So you guys looking at this chart, if you look carefully, I can't highlight it with my mouse. I wish I could. You see that little dip in the middle there between the secular bear market of the 70s and then the secular bear market starting in 2000. That little dip is 1987. I mean, it's hard to believe, but that's what Tom's talking about. Let's go to the next chart, Tom, and let's talk about this. So I have a belief that market makers are not our friends. I was joking in the green room with Tom saying, should we tell people that market makers really are empathetic, kind souls that want the best for your investments? And I'm sure all of you on the other side would be laughing, but the reality is that the markets go up on a staircase, sometimes even with a cane walking, but they go down in a really fast elevator. And that's what happened here in these 4 records that were set. Maybe touch on that a little bit, Tom, and how that affects an investor's psyche. I know that as an educator, you really have tried to prepare people for battle on this psychological issue.
Yeah, you have to be prepared for pullbacks. I mean, no matter how great the market is, sometimes it just gets ahead of itself after a while. And I think as you're looking at the number of trading days, from a record close to correction, when you look back in history, the faster the corrections, those periods that have the really fast corrections, are also the periods that follow periods that had the fastest rises. So a lot of times you're in markets that are very bullish, but once you see a little bit of selling, and I wrote about this probably within the last week, 10 days over at Stock Charts, I could see that our market was beginning to get very nervous, even though prices kept going higher. And so I wrote to members, and I'm sure you saw it, Charles, that I was starting to get very nervous in the near term and was starting to build cash in my own trading account simply because I was expecting that we might get what we saw here over this past week. And it's just a matter of, when the market gets too far ahead of itself and it begins to show certain sentiment issues, many times we see the types of corrections that you showed on your screen.
Gotcha. Before I go to the next chart, guys, if you've got questions for Tom, go ahead and start submitting them. Because we're on this delay, I'd like to just have a series of questions after we've got, the next 2 questions here, or the next 2 charts to review, if we can do that. So feel free to put that in the chat box there, and we'll go from there. All right, so moving forward, so this is a tool that I've been introduced to by Tom that really is helpful, and it's called accumulation distribution. This is a stock, the ticker symbol is ZS, Zscaler is the name of the stock. And the reason I think this is important because people always think of relative strength as being such a great indicator, but it actually can be kind of a fake out, whereas accumulation distribution is a more accurate indication of whether there's, I'm going to call it drama going on with the stock or really legitimate selling. And I think that this became important to me because I'm able to hold on to a stock longer as your portfolio manager when I can see that the accumulation distribution line is hardly moving during a sell-off or sometimes even going higher. Could you explain that, Tom? I know it's a kind of heady topic, but it's really important.
Yeah, I think it gets back a little bit to what I was talking about with the financial crisis versus the pandemic and how the market reacted, where not only were we seeing some gap downs back in 2008, but we saw continued selling once the market opened. The AD line, the beauty of it is that it doesn't take into consideration the gaps. That's probably the simplest way to describe it. It only looks at what happens during each trading day. So you could have a stock, for instance, that's trading at $20, and for whatever reasons, maybe it's the market related, or maybe it's a earnings report or something. But let's say the stock opens the next day at 18, and then finishes back up at $19.99. So it lost a penny for the day, but the AD line is going to look at that as a very, very bullish day, because once it opened at 18, buyers swamped sellers. And so we went higher all day long. So the gap down was a 10% gap down, but then we had more than a 10% recovery the rest of the day. So the AD line is really focused on what happens after the opening bell. So, we had so many stocks back in March, and you said, I introduced you to the AD line. Well, honestly, I didn't really follow the AD line until March. And that's when I started looking at all these gap downs and then recoveries, and I realized that the accumulation distribution line was the absolute perfect tool to visualize what was taking place in the market back in March. So I stumbled upon it myself, and it became such an important part of our trading strategy in 2020 that we created separate chart lists at Stock Charts to define the stocks that were really strong in terms of their AD, or accumulation distribution, and then those stocks that were very weak, because we saw a major divergence. So what would happen is we'd get a big gap down back in March, and then you would see technology stocks being bid up during the day, and then you would see energy, airlines, cruise lines, gambling stocks, hotels, all the things that truly were being majorly hurt. That's not the right word, but stocks that were really being crushed by the pandemic were stocks that were being sold off. And the best way to see that visually was looking back at those AD lines.
Yeah, and that's what I really enjoyed. And of course, it supported your philosophy that this is really a simultaneous bull and bear market. It's just astounding, really. It was even more dramatic, I think, in midsummer, when you just saw these entertainment stocks, energy stocks. I mean, Exxon kicked out of the Dow. Who would have thought that? Of course, energy's had problems long before this. But let me move to some questions here. So from Keith, Tom, when investing in a company, how deep do you go in investing that company's management team?
Well, I'll tell you what. I think Wall Street looks at management teams, and they either trust them or they don't. And I think a lot of that comes from, if you're working with somebody and they tell you, that they're going to do something. I always use the analogy. You got two salespeople. One salesperson says, I'm going to do $1 million in sales this year. And then they come in and they do 1.5 million. And then you've got another salesman says, I'm going to do $1 million, and they come in with 300,000. When they give you their forecast next year, which one are you going to believe? I think it's very important that Wall Street trusts the management teams. And so one of the things that we do, and really, I'm going to say it's really the main part of our service at Earnings Beats, is tracking the companies that are able to beat both Wall Street's revenue and earnings per share estimates. So I personally don't go in and evaluate management. I don't look at the individual folks and try to track, their history and what they've done. I simply look to see whether or not they can meet the promises. I'd rather have a company, and Apple is a perfect example of a company that promises and then over-delivers. They under-promise and over-deliver. What you don't want to be in are companies that tend to do the opposite way too often.
And those are the ones that gap down at 4:02 p.m. on their earnings day. Yeah, it's interesting that stocks and the management team both have something in common. You want ones that you can be dependably counting on them. This is from Charles. Do you see any future changes taking place in the stock market this question refers to technology changes or other accounting changes. Like you and I were talking in the green room about the SEC needing to get more involved. Are you seeing anything to prevent like the high frequency trading, not to prevent it, but to regulate it a little bit more, or the areas of the market that are just more speculative, I guess?
Yeah, I haven't really gotten too involved with the high frequency trading. I will say, that if you're an investor, you're a long-term investor, the market's very efficient and prices go where they're supposed to over time. I think when you're looking at the short term, that's where market makers are involved. That's where you got a lot of these trading programs, your high frequency traders. And yes, there's no doubt that, there's a lot of back and forth, a lot of intraday volatility and so forth. But the longer term, I think, is very efficient in the stock market. And I'm, as a trader, I'm actually somewhat thankful for the market maker system that we have, because I always say, hey, my goal is to try to get on the side of the market maker. So when I'm in a really strong stock, I wait for those pullbacks when everyone starts to panic. People who bought Tesla at 500 think down at 330 or 350 that's a horrible company. Because not because anything has changed in 2 weeks or in 1 week, but because they're down so much on their investment. And so they panic and they sell. Well, guess who's on the other side of the trades when that imbalance starts moving in the other direction? You have your market makers and hopefully astute technicians that are ready to ride it back to the upside.
Yeah, and obviously the stock's price and the stock's merit are two different issues, which is a whole nother discussion. Let me take one more, and then we're going to need to move on. But Tom's going to stick around for a little bit, and you guys can continue to ask questions in the chat. This is from Chris. All the talking heads, whoever they are, mention a 15%, 10% to 15% correction from the high. It's almost as if they chose to play find a support level and use it to scare people. Do you see the same 10 to 15%, or do you have another level in mind in this current pullback?
Well, the NASDAQ already pulled back 10%.
Yeah, it did. Correct.
We already got that. It's really hard to say. And one of the things I tell our members is, use the weakness to begin to build positions. I wish I had the crystal ball to say exactly where it's going to pull back. I guess in a way there was a little bit of a crystal ball in the sense that sentiment was giving us some really serious warnings a week ago. I mean, we had put call ratios that were incredibly low, lowest we've seen in 5 years. We had volatility rising when the stock market rises. We had the highest positive correlation between the volatility index and the S&P 500 that we had seen in the last 5 years. Those are signals that tell us that the market is not on sound footing in the short term. And so once the selling kicked in, we saw that accelerate to the downside. How far we go, my initial call on the S&P 500 was 3290, which I used Fibonacci, and that was just that first 38% area,
right?
The retracement level. So that's what I would look for. Whether we go a little bit lower than that, we might, but I do think the fourth quarter is going to be strong.
Let me just, because we've talked about the S&P and the NASDAQ and how really they are the ones leading this. This is from Keith, and then this will be the last question. Do you see the Dow Industrial being less influential in the future? My opinion is it's less influential right now, and they're sort of flailing to catch up. When Apple, you're a price-based index, which they can't undo, apparently. They thought about trying to do it, and they can't. I don't know how you have as much validity, certainly with 30 stocks, and the whole price-based weighting, which just doesn't make sense to me. But I don't mean to answer the question. Do you think the Dow is nearly as important as the S&P or the NASDAQ?
I don't follow the Dow. I look at it like it's a dinosaur. I think that you've got 30 large companies, and yes, they're making changes. They're trying to make it a little bit more relevant, I think, by adding, in recent years, putting Apple, Microsoft in there. Now you've got Salesforce.com going in, and like Charles said, Exxon coming out. So they're certainly trying to make it more relevant. But I've followed the S&P 500. I think if you're looking for an index that really covers 500 of the largest multinational companies in the world, I think that is the benchmark that most people would probably gravitate to. Now, personally, I talk a lot more about the NASDAQ but that's because I'm a trader, and you've got a lot of technology stocks on that index that move a lot.
Sure.
And so from a trading perspective, I think they're very useful to follow. But I think the S&P 500 for me is the major benchmark to follow.
Understood. Tom, I can't thank you enough. Guys, if you still got questions, put them in the chat. Tom may be with us for a little bit, or he may turn over to the NFL, but he's been known to multitask, so he may do both. Tom Bowley, everyone, so glad to have you here, and we hope to have you back.